Broadcom just posted $22.2 billion in total quarterly revenue. Yet instead of pure celebration, the underlying financial foundation reveals a dangerous structural crack. They are generating unprecedented cash, but does this massive surge mean the market is entirely wrong, or is there a hidden trap about to wipe out all their gains? When you carefully examine the second quarter report, artificial intelligence-specific semiconductor revenue hit an explosive $10.8 billion. But how does a company scale this incredibly fast without completely breaking its operational backbone? At first glance, Wall Street cheers enthusiastically because the year-over-year revenue growth sits at a staggering 143%. But underneath this surface level, euphoria lies a severe concentration risk, especially when you factor in that massive $22.2 billion in total revenue. If global tech infrastructure spending experiences even a slight cyclical slowdown, this massive revenue engine could quickly become the stock's greatest vulnerability. As an investor, you must realize that when a single technology division driving $10.8 billion becomes this dominant, you are no longer buying a safely diversified tech giant. Instead, you are buying a highly leveraged call option on hyperscaler capital expenditures. But to fully grasp why this specific dependency is happening right now, we need to carefully look at the underlying cash flow mechanics operating silently behind the curtain. Free cash flow surged to an absolutely astounding $10.26 billion in a single quarter. This vital metric simply represents the actual cash left over after a company pays for its basic operating expenses and capital expenditures. But how is Broadcom physically extracting this much pure capital from its top line without collapsing under its own massive weight? Most retail investors looking at that $10.26 billion automatically assume the company is simply selling more units. They enthusiastically point to the highly impressive 46.3% free cash flow margin as undeniable proof of total market dominance. Broadcom appears to be printing money effortlessly, immune to any macroeconomic volatility or sudden global supply chain disruptions. But when you realize that this elite cash conversion acts as the only real financial cushion keeping the balance sheet intact, the entire picture changes instantly. The massive operating margin hitting an incredible 48.6% definitively proves that Broadcom currently possesses immense pricing power. Yet this profound operational efficiency must be flawlessly maintained to fund daily operations and appease extremely aggressive institutional shareholders. However, if that crucial 46.3% free cash flow margin ever slips by even a fraction, the downward stock velocity will be completely brutal. The broader financial market forgives absolutely no weakness when valuations are currently stretched this incredibly far. And this directly brings us to a massive hidden cost buried deep in the corporate financial footnotes. Stock-based compensation reached a truly staggering $2.09 billion for the exact same quarter. Why is a company generating so much pure cash flow quietly issuing so much stock to its own internal executives and insiders? At first glance, the management team is very quick to proudly highlight a spectacular adjusted earnings per share jump of 54%. Wall Street analysts blindly applaud this specific 54% figure, loudly claiming that Broadcom is dramatically increasing underlying shareholder value. But when you look much closer, that heavily promoted adjusted earnings per share figure aggressively excludes the very real equity dilution directly caused by that $2.09 billion in stock-based compensation, representing nearly 10% of total quarterly revenue. This massive non-cash expense actually translates to heavy, permanent dilution that secretly eats away at your personal ownership stake. This severe dilution forces executive management to rapidly accelerate share repurchases just to offset the permanent financial damage. They are essentially forced to run on an exhausting financial treadmill just to keep their 54% earnings growth from collapsing completely. But before we can firmly determine if Broadcom can outrun this relentless $2.09 billion dilution, we have to look at what they are publicly promising for the immediate future. Third quarter total revenue guidance is officially set at a towering $29.4 billion. But how can executive management confidently project such an astronomical figure without completely cornering themselves into an impossible situation? Surface-level analysts immediately upgrade their bullish targets, completely blinded by the breathtaking artificial intelligence solutions revenue guidance of $16 billion. They blindly assume Broadcom will effortlessly walk over this high bar due to sheer historical momentum. But by projecting a massive 200% year-over-year revenue growth guidance for this specific division, the bold executive team is effectively cornering themselves into a dangerous position where absolute perfection is already fully priced in. This specific 200% growth metric measures the expected percentage increase in total sales compared directly to the exact same period last year. This severely elevated guidance essentially assumes zero disruptions in the highly complex global supply chain network. This means that even a very slight demand moderation from key clients could suddenly trigger a severe market reaction. The structural margin for error on that projected 200% growth is now virtually zero for investors today. So, what does this truly mean for your specific investing strategy right now? It means Broadcom is currently priced for totally flawless operational execution. Utter perfection is the only acceptable outcome to safely maintain these lofty valuation multiples. And this stark reality brings us to the final critical structural risk tying everything in this complex financial report together. Total corporate debt currently sits at a truly massive $64.9 billion. How exactly does a highly profitable company with such incredible cash flow end up carrying such a genuinely staggering liability? Optimists will immediately point directly to the balance sheet, enthusiastically highlighting that short-term liquidity proudly stands at a truly formidable $19.6 billion. They loudly argue Broadcom is completely insulated from global uncertainty or sudden market volatility. But while the current debt-to-equity ratio of 0.74 remains very manageable right now, this towering debt load quietly introduces severe long-term refinancing risks. This specific 0.74 ratio simply compares the total corporate liabilities directly to shareholder equity, showing exactly how much financial leverage is being actively used. The executive management team is brilliantly utilizing their free cash flow fortress to systematically deleverage over time. But this deleveraging process fundamentally requires an incredibly delicate balancing act to avoid aggressively compromising essential future research and development initiatives. The core trade implication for any true value investing disciple here is that massive corporate debt always powerfully amplifies both sweeping victories and crushing defeats. Aggressive shareholder return program recently saw trailing 6-month share repurchases powerfully hit an astonishing $8.45 billion. Concurrently, Broadcom maintained a stable quarterly cash dividend of $0.65 per share, keeping income-focused investors completely pacified for now. But what ultimately happens next when the overall market narrative fundamentally shifts? Returning directly to our central opening question, is the broader market entirely wrong about the Broadcom second quarter financial report? Or is there an incredibly dangerous hidden trap about to violently wipe out all their recent gains? Broadcom is undeniably executing an operational masterclass, wielding immense pricing power that actively drives their 48.6% operating margin and unprecedented fixed cost efficiency within its highly lucrative custom silicon division. However, its explosive $10.8 billion artificial intelligence-driven revenue and uniquely elite cash generation heavily mask a very severe underlying tension. This tension is built directly upon massive structural debt and aggressive stock-based compensation dilution. The company is walking a highly precarious financial tightrope where absolute hypergrowth must be flawlessly maintained just to safely outrun its looming internal liabilities. That is exactly why I believe that within the next 24 months, we will witness a truly brutal market correction for any major semiconductor giant that fails to transition from projected hypergrowth back to sustained debt-free profitability. When you apply rigorous stock market analysis, you realize companies using adjusted earnings to hide structural $2.09 billion dilution face a devastating reckoning. Broadcom must definitively prove it can fundamentally outgrow its own complex financial engineering. But I want to hear your personal take on this situation. Do you think Broadcom can sustain this massive 143% growth rate, or will their towering debt load eventually pull the stock down? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.